Do you have stock options at work, but you don't know what to do with them? Or maybe you even exercise the shares, but you just don't know where you stand tax-wise. This is where you're going to need tax planning around your stock options. Because if you don't do this, you could be leaving a lot of money on the table or even paying an exorbitant amount of taxes that was unnecessary if you just did this planning session. So a lot of the planning that we do around stock options are involving ISOs, NSOs, or if your company is about to go public or getting acquired. With tax planning around your options, it allows us to know where you stand right now when it comes to your options and your circumstances. You avoid any additional taxes that could have been avoided, taking steps needed to pay the least amount of taxes, and making a plan for next year on what to exercise and hold. One of the first things that we do when we analyze your stock option holdings is to see where you are now. Let me move this. So there are different stages that you're going to go through when you work at a company, and then there's stock options involved. And at each stage, there are different things that we could do. For example, if you started at the startup first, one of the first things that we will recommend is maybe doing an 83B election and understanding the qualified small business stock. I have videos of those in our playlist, so you can look for that. But at each phase of working at the company, or each phase of the company itself, there's going to be different things that we could do planning around your stock options. For example, if we see that, hey, your company's buying back some of the shares from the employees. So this happened with Palantir. Palantir was buying stocks back for their employees. And what I did was I helped my clients evaluate, okay, how many shares did you want to sell? What was the price that you bought it at? What's the price that they want to buy it from you? Seeing, how does it affect your taxes, whether it's long-term, short-term, and how much can you get out of it, and is it worth doing it right now? So those are some of the things that we did, especially for companies that are getting ready for IPO or maybe getting acquired. That involves a lot of planning, because now they got a lot of shares that are vested, and maybe they never did anything with it, maybe they did something with it. So we have to go through all these situations. Okay, what's going to happen once the company does go IPO, and maybe once the blackout period ends, what can you do with those stocks, and how much should you sell, whether you should exercise before IPO. And another big thing is that when I have clients that are leaving their company, so maybe it hasn't gone IPO yet, but they have all these vesting of options that happen, but they're planning to leave the company. Now, they don't know, should they exercise all those shares before they leave, or should they not exercise and just kind of lose out on that potential stock that they could have had? So definitely something to review when it comes to the planning side. So during the planning, we're going to try to figure out a few things for you, and here's some examples that we've had in the past. For example, something as simple as what happens if you exercise 1,000 shares versus 2,000 shares, because it's possible that when you exercise 1,000 shares, there are no tax consequences at all. But when you do 2,000 shares, you're going to pay a lot of taxes because you went over a certain threshold. So definitely knowing where that ceiling is to know exactly, okay, how much can you exercise before hitting any additional taxes? Another thing, it would be if you know that the fair market value of the stock right now is $1, but you feel that it could go up to $10 in a year or two, then definitely what should we be doing now when it's at a lower value compared to when it's at a higher value? Also, how much cash do you have to pay for stocks and taxes? I have some clients that will say, okay, I have $50,000 that I could use to buy the shares and pay taxes with. Exactly how many shares can I buy and pay taxes on with the $50,000? Other thing is, what are you comfortable with losing? I have a couple clients where they're working at a startup. They had an opportunity to put $10,000, $20,000 in it, and really, because you're investing in a startup, it could be highly risky. So what we evaluate, what are you actually comfortable with losing, because I don't want to put all your eggs in one basket either, unless you're very sure that the company is going to do well. But I've had clients that put $30,000, $40,000 into their company stock plan, and it didn't go anywhere. Like the company just went down. And the other thing that we do is sell to cover right here. What sell to cover is saying that you have all these stock options available for you to exercise and sell. But what you don't want to do is front any money out of your own pocket. What you're going to do is exercise and sell enough shares, get all that cash to buy whatever excess shares that you didn't exercise yet, and also cover any taxes that's associated to it. So pretty much it's kind of cashless, meaning that you're just using the equity you have in the stocks, the equity that you have in the stocks already, and using the equity to buy more shares and pay the taxes as well. So I'm going to go through a couple examples of what I do with my clients. So say for ISOs, with my clients that have ISOs, what we'll do is we'll try to exercise just enough before hitting AMT, because with ISOs, there's a limit where you could exercise and not pay any additional taxes. But once you go over that limit, you're going to pay additional taxes because you went over. So we really want to make sure where is that ceiling and we don't try to cross it. And we do that every year, where we exercise just enough before we hit that ceiling every single year. With NSOs, because it doesn't have very good tax treatment with it, we're very careful what we do with our NSOs, meaning that we try to figure out, okay, what is the delta and what is it that we could exercise before hitting the next bracket, and then seeing what the client is comfortable with paying out of pocket when it comes to the taxes itself, because with NSLs, it's an immediate tax event. So making sure the client understands that, hey, if you exercise 1,000 shares, this is how much taxes you're going to pay. Are you ready for that? And then the last thing, which is very common, especially with like DoorDash and other Airbnb going public recently, we're getting a lot of clients that, hey, I got all these RSUs and options with these companies. What's going to happen with my income tax once it goes public? And we'll run the calculation to say, okay, based off what you received as RSUs versus options, this is what you could do. With RSUs, we're kind of stuck with that income right when it goes public, whatever the value is when it goes public, that's going to be all income. But if you do have options, what can we do with the options? Should we wait a little bit before you're in a lower tax bracket? Or maybe you should exercise some options if they're ISOs, because it's going to allow you, because of your high income, it's going to allow you to exercise a lot more if you wanted to. So with your stock option, it's going to be really important that you do some tax planning around that, because one, it's going to let you know where you stand, and two, we could draw out a plan on what you should be doing the next couple years with those stock options. So if you know anyone else that would benefit from this video, please share with them, give this video a like. I'm off to my next video.